that come up. So here we are at the basic power options setting. What we're looking at here is a 14-day free trial position. Of course, those of you who are just starting your 14-day trial to power options where you don't need a credit card, remember, take advantage of the 4 steps that are listed today up at the top so you get more acquainted with the tools on the site and the various option strategies. All right, leading off, Sam says, good afternoon. Hope all in the room had a good week. Sam had sent me an email a moment ago letting me know that he had successfully rolled his Apple Iron Condor, got out of the put side for nearly full profit. His big trades, or his profitable trades this week, were MU and MBUU, and he also got 5 points on McDonald's, of course, with the upgrade as well. I had a great run with PHM today, Chipotle Home Group. It went up about $1.15, $1.20. A little great run for a long-term position I'm in. The market obviously knew what I was doing because yesterday in my married put, I rolled up the put and sold the 32 call when the stock was at 31.50. So naturally the stock goes up $1.10 today and is trading at 32.60 because I just sold the call yesterday. Still in a good position on that one, but yeah, wish I would have waited. All right, now one of the questions that came in via email real quick, and before I go on, I already have questions coming in. Another comment from Sam, a question from Jane. Let's see here, and some other comments from Sam got into nail really well also. Okay, so those questions, comments are coming up. But first I'm going to start off with Dan's question. In the beginning of the webinar, I talked about married puts, and I talked about the PHM position I was in. Of course, the married put strategy we discuss is the probably most conservative option strategy you can do. Protected stock position with a far out in time put with a proper structure to control risk to only 5 or 6%. So a lot of the webinars we do, we talk about the ins and outs of this strategy, the benefits of the blueprint, which discuss this strategy and the 12 different income methods that we use to limit risk. It represents about 55% of my total portfolio, this particular strategy. Now, a lot of people say that, well, this looks just like a long call. Okay, so let me add long calls in. I didn't realize I didn't. Oh, I do have long calls. I'm sorry. You see the graph of a married put, and you say, well, it looks exactly like the long call. Well, the graph is very similar, but they're completely different trades. See, the long call risks 100% of whatever you invest in the position. If you have a 10% loss on the stock, you might have a 70 to 80% loss on that long call. With the married put, if I have a 10% loss, something unexpected happens, well, I'm only going to be losing maybe 4 or 5% of what I invested. It's capital intensive, but it's controlling risk. But we talk about insuring stock positions so we don't get trapped with that earnings surprise, suffer a 20 to 25 or even 33% loss that I've seen with earnings surprises or just unexpected events in a long stock position. And Dan had written in and said, well, in regards to a long call, can I use a put to protect the long call? And the answer is yes, you can, but you have to remember it changes the dynamic of the position. Real quick, I'm going to go to the portfolio tools. And we're going to take a look just right now at the RadioActive portfolio, the positions I have with some of the spreads and calendar spreads. But I want to look at Polte real quick. This originally I got into the stock at 30.02 and paid $2.75 for the October 31 put. Now, why do I bring this up? Well, because yesterday what I had done is to control risk a little bit better. I rolled the 31 put up to the 32. Okay, in this case, I could actually roll to the 33. And I could have done this with a call too. If I had the 31 call, I could have moved it up in price. But let me just show you what this particular adjustment does. So I sold to close the 31. It didn't go to zero. In fact, it still has a $1.32 value today with the stock up about $2.45 from when I got in. And I'm buying a higher strike 33 put for $2.17. Well, this is a debit of about $1, just a little bit under $1, about 85 cents. Why would I do that? Well, I add to the cost basis. I sell to close this for $1.32, buy this for $2.17. It adds 85 into the $32.77 I already had in to gain a 2-point better, higher payout. So now my risk is lower to only 1.8%. Now, when I did this yesterday, of course, I just went to the 32 put, it lowered it to about 4%, and I sold the call, which lowered it even further. Had I waited a day, knock on wood, Yeah, I would have sold the 33 call today after doing this roll. Okay. And now the position, as we see here, what does this look like to you? It sort of looks like a calendar spread, doesn't it? With almost no risk. The put's still out to October. The short call expires in June. But why am I going through this when I'm talking about long calls? The reason why is the beginning structure, the stock plus the put gave us something that looked like a long call that protected it, a risk of 177 of 3277 invested. Now, let's take the opposite, or what some might consider the parity. Let's consider a long call. Let's say back when I bought PHM at 30.02, back in April, that instead I had bought that October 31 call instead of the stock and 31 put, and we only paid about 180, just around the same monetary risk, 177 of the married put position. What do we end up with? We end up with 100% risk of what we invested, but we still have a graph that looks similar to a married put position. Okay? We don't argue that. We argue the risk factor, and that if you take 100% loss, you need almost a 180% gain to get back to break even. Whereas in a married put, if I take a 4% loss, I only need a 4.3% gain to get back to break even of what I invested. But okay, how do I protect this call? Well, it's going well for me. Okay? Can I buy a put now? Well, of course you can. And you could try to lock in some of the gain. So let's say we had this call. It's now worth $3. We've got a 120 gain off a 120 investment, almost a 75% return. Okay. Now, if I buy the 33 put, it adds another $2 in the cost basis. Actually, looking at it, I'd buy the 32 put. I've got an unrealized $1.80 gain in the stock, roughly. So I can cover that by buying one strike higher, but paying about that same unrealized 180. So I think I'm going to go with a 32 put. Sorry, folks. Let's add that back in. There we go. Let's just buy one. Okay, so does this protect the call? Not really. See, my max risk is still 249 if the stock's between 31 and 32. Maybe I should go with that 33 there. It does really exacerbate this upper break even, but that's all the way to October expiration. Notice in the middle of August, there's almost no loss because both options will still retain time value, just like my put. Okay? So I have 349 invested now, but I can only lose 249 on the position. I'm still risking 177 on the married put, but this can profit both ways if the stock swings down to 29. Now, for Dan, the problem with doing this adjustment, or there's nothing wrong with protecting a long call that you're far out to with a put option, but the problem you run into is that now you've got a strangle. You've got a different position. We don't have that to the upside bullish position that the long call and the married put started off with. We now have an in-the-money strangle with a higher risk monetarily and vastly percentage-wise than what we started off with the married put or the long call. So the reason why I mentioned this to Dan, the problem with doing this, is that if your plan was to treat this long call like a calendar and now maybe sell the 33 call for June 14th or next week, which I would likely do in this case, you create something completely different. Why? I've got a put that profits if the stock falls. I've got a call now that profits if the stock moves up. But if I sell a call, it caps the upside. So now I've entered a position that may even have a loss in this direction. You change the dynamic of the trade when you try to insure a call option to create this strangle. But let's say we did what I was talking about, and we wanted to sell that 2-week out 33 call, June 22nd, 14 days out, 33 call against this in-the-money strangle structure. I don't get that same sort of profit and loss chart I had with the other married put position. Now I still have this max profit you're seeing is all the way to the downside if the stock goes to zero. This actually isn't too bad, in my opinion, because that upper break even, when you start to lose again, is all the way up around 36. But why are we losing money and going to a loss? It's again because when we had that original strangle, we profit infinitely if the stock moves up or the stock moves down. Now that we've capped the gain, if the stock does move up, we get no higher value out of the long call because of our obligation of the short, and the put loses all of its value as well. Okay? So it is one of the ways I may look to manage a long call. Buying a put, especially if I have earnings coming up. For example, if PHM had earnings coming up in the next 20 to 30 days, instead of buying an October 32 put, what I might do, well, let's say the earnings were out mid-July, July 10th. I might buy a cheap put, a July 20th, let's say 31, but I might fund it. It's 52 cents or so, so I might fund it by selling a 33 call. Wait, Mike, you just told us that if you did that, you cap the upside. Why would you do that at earnings? Because I'm going to create a bear call spread and also maybe buy the 35 or the 36. What does that do? If I sell the 33 call in this structure for July, let me clear out the June. So we're buying a short-term July 30 put for 50 cents. I'm going to sell that July 33 call at 95 and buy a 35 at 29. Not the best chart, but there's no risk now. In fact, the worst case scenario is that we only make $3 if the stock pulls back from the earnings and is trading right at 31. Infinite risk to the downside. We still have infinite risk to the upside, because if the stock moves above 35, or long call strike, yes, we may be obligated to deliver it here at 33, and that might be taken out by our 31 call, but we have a 35 call that's still increasing in value. So this gives us an unlimited upside. Sam says buy 2 calls and sell 1. Right, I could do a ratio as well. I just like this view, knowing that I have a gain in it, Sam, because I added the put to protect the downside and still give me the strangle, generated some premium to cut down the cost of that near-term put around earnings, but I leave the upside open with the bear call spread. Right, that 31-35 position is just a bear call spread. You'd say usually want that to be bearish, but if you have the long call or the long stock in place, it leaves the upside open. It's like generating a out-of-the-money covered call premium, but leaving the upside open for the gap. That's called income method number 6 in radioactive trading, the bear call spread. Okay, so that's something to consider, and that's something that we like to use. But again, in general, remember, if you buy a put to protect your gain in a long call, you're creating a different position where you might have that loss in the U-shaped form that might be higher than what your original expected loss was, because you're adding a new time premium and a new cost with that new put you're purchasing against your long call. All right, so I just wanted to cover that for Dan real quick to talk about why buying a put against a long call is insuring it. It is giving you an exit, but you're creating a different position known as a strangle, which can profit to the downside and the upside, but it can increase the risk because you're adding extra time value. And if you try to sell a call against it, then you're actually creating a bearish position on a stock you still might be bullish on. You're almost trading against yourself. And for what Sam said, with leaving the upside open with adding the ratio spread, or what I just showed, if you're around earnings and you're holding a long call further out in time, you might want to use that short-term put and help pay for it with that short-term bear call spread, which leaves the upside open through earnings, and you can actually profit on the downside if there's an unexpected swing. Okay, let's get to Jane's question. And Jane, I am going to walk through this very slowly and jot down notes as I do it, so I make sure I have it correctly. All right, Jane clarifies this, says, I'm a newbie. That's okay, Jane. That's perfectly fine. That's why we're here. On advice of a guru, I bought to open one EXPR 11 strike put for October expiration at 250. Later on, I learned to read a chart. To my horror, I noticed the stock was in an upward mode, but downward. Naturally, you're losing money. How can we lessen the potential loss, if not wipe out any loss? All right. So it's on theme actually with the question we just answered for Dan. It said, oh, I'm sorry, that was upward mode, not downward, correcting but to not. Okay, Jane, gotcha. I was confused on that for a second, but now we're good. All right, so let's see where we are. We're going to just stick with the custom spread tool. Now what I may do, Jane, is put it into the portfolio. Actually, I'm going to do that first. Let me put it into the portfolio real quick. So if you haven't created a portfolio yet, you can go to Setup and just create a portfolio from scratch. Let's just do that. Oh, shoot. And take that out there. Sorry about that, folks. That was for another customer. We'll call this EXPR put. Let's put in $5,000 for now. Copy that over. Let's say we did this. Doesn't matter the date. Let's 6/1. Okay, so I just created a whole new portfolio. In the setup field, you just put in a name, starting cash on hand equal to the starting basis before I enter my trades. Now, I'm going to go to portfolios where we track our open positions up here. And we bought one long put, so I'm going to go to the select strategy menu. If you're just starting out with a portfolio, remember if you're doing a covered call, you don't want to enter a long stock and a short call. Enter it as a covered call so it's a linked position. Enter a spread as a bull call, bull put, bear call so it's a linked position and you get better analysis, not the individual legs. But here we're just in a long put. All right, our stock is EXPR, so I've got to select from the chain the put that we have. Put in our symbol. Oop. All right, October expiration, 11 strike put. Simple one contract position. Again, I'll change it to 6/1 for us. Your cost, I'm sorry, was $2.50, so we're down 90 cents on this position. Okay. Now, the portfolio is going to show me that. We bought the position at $2.50. It's currently down 98 cents. It's actually $1.53 at midpoint between the bid and the ask. So we're looking at a 39% loss on this position. What's more important, of course, is the stock's at $10.50. It's relevant, but might be problematic, but it should be okay. Before I do anything, let's take a look at the stock chart. Okay. Yeah, this is good, but let's take a look at some of our indicators. I'm just going to go to a 3-month chart, Jane, and this is how I always set up my chart. We're going to put in the 20-day moving average because I like to use the Bollinger Bands, which are based on 20-day, MACD before RSI, RSI, and volume. Of course, you could use stochastics, Williams %R, whichever you like to use. These are just my basic settings, usually a 3-month or 6-month chart. Yeah, see, there's a recent MACD crossover. That's a problem. We had it right here. Started to move back up above the 20-day moving average, and it hasn't stopped. And actually, we're on pretty close to a Bollinger Band breakout. What I expect to see with a Bollinger Band breakout, and what do I mean by that, Jane? Something that Ernie uses for his long call screens. He looks for stocks that have opened or broken above the upper Bollinger Band and had at least one close above it. And here we have 2 or 3 after it closed right at or above the Bollinger Band. What do I typically expect to see when this happens? A hesitation, maybe come back down to 10, but then usually see it move back up. A lot of things are going to be related to that, market-wise, sector-wise, things of that nature. But that's kind of the chart Ernie looks for his Bollinger Band breakout. See, you almost see it back here too, don't we? Last time it had this MACD crossover, you had a sort of a Bollinger Band breakout here and here, mostly confirmed here, but then there was that pullback. And then it just went right back up after some hesitation. We're in an uptrend. That's a long story, but those are the ways I look at it, Jane. That is a concern. All right, 2 concerns now. That's the first step. I need to know what to start. Express Inc. Now we see what the chart looks like. Gained 3% today. All right. So where are we? We're lost 98 cents, 30% of what we're down. One other thing I want to check first, Jane, or next, is I'm going to go to Research. I'm going to go to Stock Research. This is a really positive earnings per share growth. That's unnerving. Next earnings aren't until 8/22. That's pretty good. No dividend to worry about. So these are the things that I want to concern myself with. You may also look at other things, days to short interest, market cap, price to earnings, price to sales, and more. Okay, so I just wanted to know where we're standing. We don't have any fear of earnings coming up as well. Going back to the chart very quickly. Oh, that I just erased. I am sorry. Let me go back to the chart very quickly. Wow. Well, I need that. I'm going to need that in a minute. I'm sorry, Jane, but let's go to big charts. Oh, I forgot to store my settings. I'm sorry. Anyway, why I'm going back to the chart is Sam had mentioned, let's not worry about that. Let's just do Bollinger Bands, MACD, and so forth. Okay. Sam threw in his commentary, and Sam does a lot of strangles, buying calls, buying puts, selling against them, following the trend. And so why I wanted to go to the chart is I scrolled down, as I mentioned, in this case. Sam said it's trying to fill the gap at 1150, is his opinion. The last two earnings that have moved higher. So the earnings have been positive, he's noticed. And Sam says at 11 it could be a double top reversal, and we're at 1050 right now. So we're in an uptrend. We're in a put that's losing money. What are we going to be able to do? Okay, well, just as we saw before, Sam brings up a point. It would be expensive at this point, but Sam brings up an interesting point. If you have the funds, Jane, and I don't know if you do, it's not a problem if you don't. One option is I could buy 100 shares of stock right now at 1050. This puts me in a bullish position, but I don't like this. The risk is too high right now. It's 15.4% on the position. Okay, so this would put you in a bullish trend, not a bearish one, but a bullish one. Can we mimic that by doing what we just saw? Perhaps. We're in an upward trend. We're concerned that the stock's going to continue up. We've got the put in place if it reverses. Okay, so what I could do is I could go out to October. I could go shorter. But let's go shorter term for the cheaper cost. And let's go cheap. I could buy an out-of-the-money 11 call. This is going to add to the cost basis, but not to the risk. Right? Originally, you're risking 250. Between now and July, purchasing this 11 call for 38 cents roughly, because of the strike, you're at the same strike. You're at a short-term straddle, same strike price. Where this, yes, the July 11 out-of-the-money call is going to decay rapidly, but if the stock moves up in the next 10 days and goes to 11 or 1120, let's go halfway. July 2nd from today, July 2nd to before X, well, let's go to 627. All right, 20 days from now, 19 days from now, about 21 days to expiration. See, in this case, you'd still have a large loss on that put, but you've gained a little bit back, so you're only down $1.18 on the position. Unfortunately, that's about the same as where we are now. But these volatilities might shift too, which could be a problem. But if it really goes up, we could be okay. But this is the key. The upper and lower break-evens are really stretched. Might not be the best play. You could go further out, and this is Sam's idea. So instead of buying the shorter term cheap call, what if I buy a slightly in the money 10 call for $1.50? Far out in time, so we have multiple time frames and we'll cross in earnings. My maximum risk does go up to, sorry, this isn't as attractive as I was hoping. The maximum risk goes up to 308. But now, what I may be able to do is go short term, and I don't know if you're allowed to do this, but maybe sell the 11 call. Again, this will create that position we're not fond of. No, I wouldn't do this. This is the chart I was talking about before. When you create that strangle and you sell a call, this is what I don't want, Jane. So scratch that. This is why I wouldn't want to sell a call unless you feel really strong that it's not going to hit 11. You know, but we might see more run on this one. So if you're in a put, let's go back to square one. If you're in a put that's going against you, the first thought is I could sell an out-of-the-money put to start hedging some of this loss. We could create a calendar put spread in this situation. The stock's at 10.50. June 5th is too close. Yeah, it's only 5 cents. So maybe going to July, if we sold the 9 or 10, still only get 10 or 15 cents. But if I sell the 10 strike put, shorter term, I can still benefit from downside. Oh, no, we can't. See, this hedges your cost basis. That takes care of some of the risk on the position, but there's no chance for profit. If the stock's trading right at 10 here, in this case, what we'd want to have happen in the next 42 days is you'd want the stock to be somewhere around here. So the put still retains most of its value, and this put, the 10 strike put, would expire worthless. If it falls, you may have to buy shares of stock at 10. Okay, and that doesn't look like that's going to match your goals for the position. But, again, that would go back to a bullish play. All right. So we've seen some of the graphs. We've thrown some things at you. We've thrown some pictures at you. Let's break it down. Number one, get out. Doesn't look like it's a good trade. Sure, in time, EXPR could fall down. In price, you could get a profit on this position. But again, if you're worried about it continuing to move up, you can't afford to take the full loss on the trade. Number one, get out, take the loss. Look for a better chart for a long call or a long put to try to make some of this 30% you lost on the position back. Number two, we could roll the put down. All right, the stock has been moving up. I'm sorry, we could move the put up. You could sell this and take a loss and buy maybe a 12 strike put. So if the stock falls from there, you're further hedged with a deeper in the money put. It's going to increase the cost and increase the risk. But if you think it's going to reverse, you could roll up the put. It would increase the debit and increase the risk, but you might get a higher return if the stock does pull back later on. Okay, but with the stock only at 10.50 right now and you still holding the 11 put, I don't think it's necessary to roll up the strike. Number three, this one here, create a calendar. But it's complicated if you create a calendar. And this one doesn't offer weekly, so you have to stick with July, which is 42 days out. So you're sitting on it for a while. But if we do sell the 10 for the best premium, you want the stock to be trading somewhere between $11 and $10 as it is right now in 42 days. If it continues to go up, your risk is lowered, but you're still risking 100% of that new cost basis of $2.12 because you did generate 38 cents of premium, all right? So create a calendar. Number four, we saw what we could do with adding a long call to create the ITM strangle, or do it shorter term and cheaply. Don't do next week. Do further out in time, at least 1 month. We could create the strangle on the position. I wasn't a fan of this because the upper and lower break-evens were too wide. Right, here we are right here. This was about $13 break even. This was about $8, I think, break even. That's a very wide swing. Okay, and remember, this was to July expiration. So in that case, it wouldn't really work too well on that position. Let's see here. Oops, sorry. Okay, and then I've got some other comments here. Okay, so we talked about, the other question is if you think it's bullish, if you had the funds, Jane, you could buy the stock to create the married put, but the risk was above 15.6% on the position. Okay, so, sorry, folks. I don't like any of these adjustments that I might use in this situation, honestly. This one we didn't look at. Roll up the strike, but I need it to pull back after that. It's potential, but I need it to pull back. This doesn't look good, although you do lower the cost basis, that creating the calendar spread. Get out is always an option. Lick your wounds, move on to a new position with a better chart that matches if you're buying a long call or a long put. Strangle was too wide of a risk for me. Buying the stock right now, it had too much of a risk of 15.6%, but if it continues up, you're going to profit to the upside, okay? But you're in a married put position now that is protected. You could only lose 15.6%, but now that's if the stock does fall. you know, we heard the commentary from Sam about looking for that gap up to 1150 and seeing the double top and it could pull back. Mark makes a comment that half of the time he went out and looked at the chart afterwards as on the side as we're talking about this, but Mark says half of the time it looks like EXPR really pulls back down after a positive earnings. It has a run up, pulls back down, has a run up, pulls back down. Let's take a look. And I'll go, shoot, I got to clear out the drawings there for us. Okay, 2 years, and let's just change this to earnings. All right, so well, earnings have been negative, but yeah, this last earnings was positive and the last earnings was positive. But yeah, see, here's the negative earnings, and then it moves up, and then negative earnings moved up and then dropped. Negative earnings dropped, negative earnings, and they have positive one, and the most recent one here as well is probably someone that you can tell here, this big one that we saw at the beginning of June, that was another positive earnings that's no longer not being marked here. So then we had another positive earnings. We have 2 earnings in a row. But over the last 2 years, it seems they've all been negative down earnings, where we have the positive earnings here, which is also a disturbing trend. And we look at the chart, positive MACD now going above the divergence line. A lot of things look bullish on this position. So we can't do anything today. What am I going to look for next week? Well, we talked about that Bollinger Band top. We talked about some ideas, Jane, that you could use. I can't give you direct trading advice, but in this case, what I'm looking at here is, excuse me, I apologize. I can't give you direct advice, but I don't like any of the adjustments that we would do. What I'd say, Jane, is wait. Now, Jane does comment in. We tend to throw stuff out here for the management, adding another option, creating a calendar. Those are common adjustments. But Jane says she doesn't need to profit. She's going to get out and consider it a lesson. She's too new to do complicated things. And from now on, we're going to do the charts before believing any guru from now on. And you can always use us as a backup. Now, again, I can't give you trading advice, Jane, but if you see another suggestion there on that, and another suggestion comes out and you want to take a look at it, well, if you call the office or send us an email, Ernie and I can review the chart with you and say maybe it is, maybe it isn't, based on the current trend. But again, that's something that we could consider. So where I was going with that, of course, is that looking at where we are now on the chart, in the next few days, I'd wait a few days. You've got time on your side, okay? Even if the stock stabilizes right now and holds 1020 to 1070 for the next 20 to 30 days, you have an October put. You're not going to lose that much time value. You might lose another 20 to 30 cents, but it's not going to go to zero. So you've got time. So as I talked about that Bollinger Band breakout and how you see that hesitation, maybe it's okay to wait a little bit to see what happens if you get a pullback and you can get a better price for it instead of getting out at what we saw at 180 was at 160. Maybe we can get out at 190, maybe $2, take less of a loss. So see how it starts playing out next week, and remember, anything can happen over the weekend. So the market as a whole could be down on Monday. We don't know. Another comment from Sam. He's looking at it, says the growth rate is -7, so it's overvalued compared to the price at 1050. The stock analysis does not look too good there. Okay, so that's just another comment on that one as well. Okay. Okay, and Sam says, yeah, but maybe just get out now. Yeah, retail's not doing bad now, so that's part of the other issue. Okay. All right, so let's go back here. You can also use the long put search on PowerOptions that'll look for stocks that are in a downtrend and showing the opposite Bollinger Band breakout to the downside instead of to the upside. Ben says, you know, it's best maybe to move on, and you can check out things like stock charts to find the stronger stocks as well for calls and puts on. A lot of the ones on he lists real quick: Amazon, Netflix, Adobe, CRM, COP, and so forth. Twitter, MRU. All right. Okay, so that's covering Jane's comment there. All right. Okay, let's see here. Oh, yeah, and Sam mentioned this earlier. I think it's more related to a broader question there, but in relation to Jane's comment is that Sam had said, remember, we should always talk about position sizing and risk management, and meaning we don't know your portfolio size, Jane, we don't need to, but when doing a long call or a long put, this is the lesson. I mean, your long put is not what we talked about earlier with the married put compared to the long call, but the long put would be similar to the opposite with a married call if I had shorted the stock and bought a call on EXPR as opposed to buying the put. Well, even if it started to move against me, the risk on the short stock that's covered by the call could only lose 5 or 6%, not 30%, not 52%, right? That wouldn't be heard of. So when you're using in your portfolio, you're buying calls, you're buying puts, always remember that you are risking 100%. And you can see a quick turnaround. Well, in this case, we saw a slow move up in the wrong direction, but in just that short time, you're down 39 to 40%. You know, if you take a 25% loss on a trade, you need a 33% gain on the money you have left to get back to break even. And if you take a 33% loss, you need a 50% gain on what you have left. That's the lie of leverage. It works both ways in that scenario. So what Sam is referring to is that if you're buying calls in this case, doing any kind of strangle, make sure the maximum risk that could potentially be realized doesn't represent more than maybe 3, 4, 5% of your total portfolio. So even if you take 100% loss here, you still have 95% of your capital you started off with before you entered the trade as well. Okay. Now, is this Rhajiv? Yes, and then we've got Mark's questions. Rhajiv says, I need your input in an unusual put option. Okay. And he says, a stock SDRL, one strike, January 19 at 87 cents. Okay, let's go to the chain. Take a look at that chain, SDRL. And I want to go to January. Did you say 2020 or January 19? Okay, January 19. All right. It's at 43 cents. And you're looking at a put at 87. Yeah, so you're looking at the $1 put with an 87 put. So that's 40 cents of intrinsic value. I'm sorry, 57 cents of intrinsic value, right? Because the stock's at 43. You're looking at a $1 strike on SDRL. So your put is 57 cents in the money, 30 cents of extrinsic value for 224 days. And you say, why is that so high? Look at the implied volatility. It's 324%. Okay, that's about 5 times above the average implied volatility. Why? I don't know. Probably because the stock is trading so low, because the stock has fallen drastically. It's always been in this range, but SDRL, I remember before all different various splits, this is adjusted too. But the implied volatility is so high for something this small because it tends to swing wildly. A 10-cent movement is a 25% movement. Only moved 1 cent today. That's 3.2%. All right, so you've got high volatility. That's going to inflate the premium. What's the risk? 2 risks. The stock doesn't continue down to where you can make a profit because it's only at 43 cents now, or the implied volatility goes back to, nothing here is normal, by the way. But let's say it even drops to 1.4, you'd lose 60% of that 30-cent time premium without the stock even moving, maybe more. Let's take a look. Theoretically, let's take a look at the Black-Scholes calculator here. And so the out-of-the-money calls are 1.44, 1.47. This doesn't look like any kind of thing that I would ever trade. Oh, no, I didn't want to go to put research. It's okay. Calculators. My apologies, folks. Black-Scholes. Yeah, the volatility is really high. So let's say the volatility drops down to just 1.0 instead of the 1.1 instead of the 3.25 it is right now. Yeah, sorry. All right, So without the stock even moving, if it stays at 43 cents, oh, sorry, there's my chart. Yeah, see, the expected put bid would lose 20 cents if the implied volatility fell. Okay, so it's a fourth of your investment, a little bit less than a fourth of your investment. If it happens, a month out in time, you're down into the 60-cent range or so. Oh, it's just holding intrinsic value. You lose all of that time premium. So that's the real risk there on that position. So I don't know what your goal is there. If you think it's going to go to zero, if you think it's going to continue down, if it's worth it. With the stock being at 43, instead of trading the option and fighting this implied volatility, maybe just, if you're bullish, buy a share, 2 or 3 stock, or short 2 or 3 shares of the stock, which might generate a better premium than buying, depending on your outlook and your direction. Because yeah, you're right. You're doubling up almost the time premium on this position. It's really not. It's about 57 cents to 30 cents. 30 cents is the time premium for 224 days on a 43-cent position. I don't know if playing any of that's worth it. It's because the implied volatility. Why? I don't know. Okay. Mark is kind of saying, you said Sam buys debit strangles and sells credits against them. Are those further away from the market? Debit iron condor calendars. It's a various mix. Sometimes it's condors that Sam has sent me. Sometimes it's calendars. Sometimes they're out of the money. The sells are usually out of the money. The longs can be out or in the money as well, Mark. So it varies depending on what he feels and yeah. What he feels, what direction, and he's usually directional. He might not have the condor open all the time, but he did have one on Apple earlier as well. And he even said earlier, Sam mentioned earlier, he says he feels his best strategy is going long the strangle. So that's out of the money call, out of the money put. Sell calls or puts as the market develops. So you're not really always in a condor or always in a diagonal, but when you see a trend based on what he does, he sells calls and does that as well. Yeah, and Sam comments also on what we were looking at there, the risky position. No, Rhajiv, the risk on buying that put, you said risk is only 13 cents. No, I'm sorry, it's 30 cents. Okay, the stock's at 43. That 87 strike you were looking at was the dollar strike difference. So the 87, oh, I'm sorry, you're right. Yeah, the risk is only 30. I apologize. I apologize there, but I was saying that with the stock at 43, no, the stock's trading at 43 cents. You're buying a $1 put for 87 cents. What I was saying is, of that premium, okay, 57 cents is, yeah, I'm sorry, whew. Yeah, okay. Yeah, let's take a look at that. Yeah, so that's the risk there. Why? Okay, yeah, so anyway, let's take a look at that. Yeah, the risk is 13, the max profit is 13 cents. What? It does not like that strike at all. Oh yeah, no, that's right. The max profit is 13 cents, not the max risk if you buy it. I thought you were saying you were buying, not selling. I apologize. You're selling. I'm sorry, you're selling an in the money. I didn't see that. Sorry, Rhajiv. You're selling the in the money at 87, yeah. So the risk is 13, and yeah, my apologies. Complete reverse. That's what I was looking at. I was looking at it as a buy, not a sell. So in this case, yeah, if the implied volatility crashes, that's in your favor because you might be able to buy this back at 60. What's the risk? I have absolutely no idea other than the stock gapping down or going bankrupt or gapping down. Okay, so yeah, the risk is only 13 cents. I'm sorry, we were looking at that wrong. My apologies on that one. Okay, yeah, so I thought you were buying. The way that it looked originally, I thought it was a buy. Okay, as well. All right, so. Yeah, Sam talks about when a stock's at that low range, and this is something that I had mentioned too, it might be best to buy and then get out later on. Get buy and look for a pop as well. Okay, yeah, so if you keep it to the end of the sell, naked put, My concern though, Rhajiv, is this one could backfire on you quickly. Yes, the risk is only 13 cents. Look at it this way. If someone knows something out there and is actually expecting the stock to go much lower, you sell this put at 87. Sure, there's someone on the other side who bought it, but you might get assigned early. Be forced to buy the shares of stock at 1. Okay, you keep the 87, so your risk is 13. But if that stock goes to bankruptcy, well, you know, what is going on with the stock, and is it going to bankruptcy? Is it worth it? I don't know. I don't play these. I don't look at them. I especially don't touch anything selling or buying that has that high of an implied volatility. I'd rather move on to something consistent as well. And in regards to that, Rhajiv, Sam's got a question for you. Just he says you haven't asked about Delta Airlines in a while. Did you get out of that? Were you fed up with Delta Airlines? Or are you still managing that position? Okay. All right, so let's go back here. I think I had another comment or question from Mark. Oh, no, Mark was just making the comments earlier in regards to that. There wasn't a direct question on that as well. Okay. All right. Okay, so now we're going to take a look at something here for Rhajiv again. Yeah, Sam, Rhajiv, I'm sorry, you're talking about moving the put in. I'm pretty sure we didn't record this. I thought I did last week, or I meant to do it here in the portfolio. I'm pretty sure I didn't. Yeah, that's all right, but it's okay. Oh, wait, maybe I did. Nope, didn't. That was the AMD discussion from the email. Okay, that's all right. So Rhajiv has been in the he's been in INTC married put position. Yeah, I'm kind of just thinking to myself out loud here, kind of mad at myself that I didn't wait a day on PHM, and I did that income method number 4 and 1 yesterday to watch it go up today. It could have been bulletproof on that trade today had I done it. Oh well. Never look a profit in gift horse in the mouth, they say. Okay. All right, so I believe you have the 57.5 put for September. And at the time, I thought it was maybe $3 or $4 that you paid for it when you got in. I thought you legged into it. Maybe it's not that much. Maybe it was $4.50. That's okay. Oh, not $4.50. I'm sorry, but it's okay. I just put $3.90. All right, and then you've got your bear call that went against you. Oh no, it's actually looking pretty good now. You had the 57.5 for July. Okay, so you did the income method number 6 against it for July. 55 call, 57.5 call. I think it was somewhere along the lines of a 50-cent premium. So we did a bear call on top of the nested trade, got about 50 cents net credit, and somewhere along this position, maybe a little bit more, maybe a little bit less, it's okay. Now, what you're talking about is you're going to move the put. You closed this spread and then rolled up to the 57.5. Okay, I see what you did. So what you did is you bought to close the 55, sold to close the 57.5, and then ended up selling just the straight July 57.5 call after you'd previously bought it back for about a 3-cent debit. Okay, I'm sorry. So let's just put this at 1 cent, and we'll increase this to about 52.04. That'll reflect the 3-cent debit. Okay, so if my numbers are close, you're still at a bulletproof position. If you were before, it's okay. But now you're planning on moving the put from 57.5 from September into July 56 for a credit. Well, you're saying you're getting a $2 credit on that. Let's take a look. We know where we are now. You sell the September 57.5 put at around 445. You said buy the July 20th. It looks like you said 56. July 27th. 56 put at 246. Yes, you get a $2 credit and you lower the insurance by 150. So really you're just getting an extra 50 cents out of it. That's what it comes down to. It's an extra 50 cents. What are you giving up for 50 cents? So you're gaining $2 here, but you're getting $1.50 lower guaranteed payout. That's the 50 cents, the difference I'm talking about. You're giving up $1.50 to gain 2. That's still a win of 50 cents credit, 50 cents lowering the cost basis on the position, okay? What are you giving up? Well, you're moving from 224 days of insurance right now to 49 days. So 1/4 of the time, roughly, is where we're going with this. So you give up time to get a little bit more credit, but then you're probably going to be out of the position sometime within the next 2 or 3 weeks before July 27th expiration. So again, it just depends long term. The benefit here is a 50-cent difference, okay, as well, okay, on that one. So it's doable. It's something you do to generate premium, but you're giving up your time, which may be okay based on your outlook and what your goals are for the position. But that's what it's going to do. You are going to get $2, but you're giving up $1.50 less if the stock remains below 56 or 57.5. So you don't get as high a guaranteed profit on that position. And your short call, oops, that's going to look better. We sold at 50. There we go. Okay, so now I'm sorry. Now you've got a guaranteed sort of spread position because you're out to July 27. You've got the July 20 57.5 call. I'm sorry, I didn't have it sold, Rhajiv. My apologies on that. But still, it's a similar bulletproof 3.6%, max return of 6.9. I don't see anything wrong with this, but you're shortening the time. So if you think INTC has more upside, 90 to 110 to 120 days away, you're giving that up right now by shortening the position. To answer the other comments between users, Rhajiv says he's out of Delta because of oil. He's not in airlines right now because of oil. Might get back in if it pulls back to the 65 price range, okay? Okay. All right, so that's the trade-off we're getting there. Okay. All right, so looking at another comment here. Going back to something that Sam said, and Sam, I've told you why I don't do this personally. Sam says he's surprised that we don't see a lot more questions about the SPY calls and puts, buying calls, buying puts, and just moving with the trend of the market, okay? Especially now that they offer 3 days per week expiration series. SPY has a Monday expiration, June 11th, a Wednesday expiration, June 13th, a Friday expiration, next Monday, next Wednesday, next Friday, next Monday, next Wednesday, next Friday, which also happens to be Q2, June 29th. And a Tuesday, or is that a Monday? Oh, that got weird. It's a Monday, July 2nd, is that right? Monday, July 2nd expiration, Tuesday, July 3rd, because 4th of July falls in the middle of the week and the market's closed on Wednesday. So you have a Monday expiration, a Tuesday expiration, and then a Friday expiration. So Sam says, why don't we see more people talking about this and more people doing it? The costs are low. Yes, absolutely they are, Sam. The costs are low for 2-day and 3-day trades. I think the fear is that if most people haven't been successful long term with buying calls and buying puts without external management. So a lot of us, myself included, I personally fear picking the right strike and the right timing to get a 1-day or 2-day profitable call or profitable put. Why? Why am I afraid? Well, because this is what I actually am doing during the day. I'm writing webinars. I had 5 phone calls today, one that was 55 minutes long, one that was 45 minutes long, one that was 62 minutes long, coaching sessions, one that was 20 minutes long, one that was 30 minutes long, and then I think I had a conversation with Ernie as well. So just looking at that, that's 1 hour, 2 hour, 3, 3:45, 4, about 4 hours and 15 minutes of my day today when the market was open was spent on the phone with customers and talking about strategies, using the tools, evaluating the portfolio, in addition to probably the 45 to 50 minutes it took me to answer about 12 to 10 emails. Okay, so that's another 5 hours or so. So that's been most of my market day. I don't have the time to watch it consistently and move up and down. All right, you need to watch it more closely, and you need to do that as well. I'm not, Sam, you're doing excellent with what you're doing, and I know SPY isn't all of your profits, but you've been doing very well on that. But I can't watch the market like you can. And you've seen that before, because half the time when you send me an email and you say, hey, here's my newest trade in this, and you say, yeah, you send me your trades, sometimes by the time I look at your email, I've been on the phone for 35 minutes and the trend is actually different, or you've gotten out of the trade already. So sometimes when I see your trades, I don't respond for about an hour because I just started a coaching session. And Mark makes a comment. He says, yes, but what is the trend of the market on SPY? At the beginning of the webinar, and this isn't what Sam does, but sometimes he sends me things like this. He has his own charting, and I don't want to spend too much time on this in that relationship. But what I've started, when I start looking at the end of the day on PHM today, I'll use PHM as an example. I sold that 32 call yesterday for 40 cents. And a lot of times when I see what Sam sends me for a screenshot, he's looking at things such as the MACD. Okay, and you know he's got other things going on there too, but he's got the MACD in there, and he's looking for the trends and the crossovers. So a lot of times I might see an email from Sam. So this is the 1-day 5-minute chart, and right at here, Sam might have been doing calls, and then likely would have maybe sold the calls and bought puts here, or he would have sold calls against the calls that maybe are out to Wednesday of next week, but he would have sold calls here and see a crossover, and then maybe gone back to a different buy or bought a put when he saw a different crossover to the negative. But here was the condensing period where selling was probably good. Selling a call or a put might, this is PHM, not SPY, by the way, completely different in that situation. But, you know, that's what it said. And Sam says, oh, shoot, Sam, that just disappeared. I think you said it's overbought, but looks long-term bullish on the position, okay, as well. And Rhajiv made a comment, too, regarding the market. Let's just go to SPY. It'll be easier. Excuse me. Sorry, folks. Rhajiv said today was supposed to be a down day, but it ended up being an up day. Well, I don't consider it an update, should be an up day or down day until I look at the market. Okay, so here's SPY, and Mark, as complicated it is, you see the crossovers I'm talking about. This is a likely look to be a change in direction, but it didn't last, right? It looked like there was a crossover, but it didn't, and it pulled back, but then it hesitated, and then it crossed again. And then it crossed again. You know, and I'm not going to say Sam traded on all of these, but, you know, he's looking for the kind of trend line going there, but he's looking at the crossovers as when to sell a call. And a lot of his charts he sends me, it's when movements happen that are more pronounced than what I'm seeing here. Okay. Rhajiv says you're looking at Ford. You've now reduced your positions to only 1,300 shares on Ford, but you're holding for a dividend. Okay. In that case, do I do a married put on this? Well, that depends on your cost basis, Rhajiv. You know me, I would say yes. Okay, but let's check out Ford, and let's go back to 3-month. Get to daily. All right. Okay, so just like everything else, it had sort of the crossover the past few days. It's been being pulled up. Not quite a Bollinger Band breakout, but close. Cost is around 11.15. Didn't update both at the same time. I apologize. Much better. Still similar. Nice long run. Not close to a Bollinger Band breakout, but not quite what I'd like to see a little more. But it is pushing that upper Bollinger Band. It's looking really good over the last couple of weeks. It's at 12.10. Your cost basis is 11.15. Okay, I would do it. It's going to be expensive. We know that, but that's okay. 13 puts. If I go to married put and insurance. Oh, first things first. My apologies. Let's go to Ford. I want to see when your dividend is. Earnings on 7/25. It's a month away, but another reason to add it. Last was on 4/19, so the next is 7/19 right before earnings. If it's there, I'm going 7/27. I'm going to a married put to lock in some of the profit on that position, still get the dividend, and have the put still past the 27th if I don't close the position ahead of time. I might even go a lot further, to tell you the truth. Let me just go to July. Let's see what comes up first. This would be the cheapest route. Yeah, July 27th with the stock at 12.10 now. See these right here. This gives you a guaranteed 7.2% profit if you buy the 13. Okay, based on your cost base. It's going to cost you 98 cents. Puts your cost base up to 12.13. Guaranteed to get 87 cents back. So you've got a locked-in profit of 7.2%. Damn near close to the profit you have right now. Pardon my French. It's not too far off. Your current profit's 8.5. This guarantees 7.2 for 49 days. You cross the next dividend date and the earnings on the 25th if that's when they come out. Was that confirmed? I forgot to look. Oh, it's not confirmed. Okay, so maybe even going out to August 1st if it's available or sometime in August. But you liquidate now, you make 8.5%. You want to hold on further. What if the stock pulls back 5%? You only make 3% profit plus the dividend. You lock it in, you're guaranteed in the worst case to be a 7.2% profit. You get the other dividend, so that pushes that up higher to maybe where you are now. Right? The Ford is a dividend of 15 cents, roughly. Okay? So that would lower your cost basis to 11 after you cross the dividend. You've guaranteed a profit equal to what you have now if you liquidate the position. That's guaranteed. It can continue to go up. Now, it has to go up above 13. But, oh, by the way, now that you're in that, before the dividends appear, I know it's only 5 cents on 1,300 shares, and we're talking about a larger number here. It's 98 cents times 1,300 shares. That's not right. Yeah, buy, sell. Okay, yeah, so not exactly a great one, but you could still generate premium and guarantee a higher payout, still a good profit on the position. We could go out further. When was the dividend again? July, what did I say? Okay, so I could go maybe all the way out to July 6th. That 13 call, still only 3 or 4 cents. Man. Okay, so that gives you even that chart now with a guaranteed 8.9% return, 11.2% max return if the stock's at 13. And by the way, that does include the dividend because I knocked it down to 11. Okay, so there you go. Yeah, so a comment comes in, F is a buy. It's coming from 1050 since January 18. It's doing better than the industry as well. And of course, some of the outside industries took a hit. Ford does have that strong chart growth rate of about 14% as well. Okay, that's the reason you're never selling call against it. Yeah, even with 1,300 shares, only getting 3 or 4 cents for that good cushion out of the money. I get it. I don't like that either. So, but let's take that out of the equation again. If earnings are going to be out the 25th, you might want to look at August, but you're there. I mean, if you liquidated right now before the dividend, you make that profit. You do this, you're guaranteed that profit. And if Ford keeps continuing up in another month, you might see it at 13. If it continues this pattern, you might see it at 13, 13.50. You'll get a higher profit up to the 180 range, which would push you almost to 11, 12% gain. But knowing that in the worst case scenario, you go out to that first week of August, you can even cross earnings with no chance for a loss on the position. Now, if you doubled up, you would have a chance for a loss, I think, at the peak. So if you bought 2 puts, Oh man, you're in a no-risk strangle if you buy 213 puts, but that's for July 27th. You might want to go out further in time on that one as well. To August, so I can't confirm that the earnings are going to be on the 25th. Okay, that's when the expected date is. It could be the 28th, in which case the 27th doesn't do you much good. You might want to go further out in time on that one as well. All right. Well, ladies and gentlemen, I actually don't see any other questions that have come in this afternoon. If anyone has any last-minute questions, go ahead and send those in. Of course, I want to remind everyone, if you haven't done so already, remember you can go to PowerOp.com, put in your first name, last name, email address. You can get a 14-day free trial, full access to the site for 14 days, no credit card required. We didn't cover the search tool today, but we did look at the benefits of the portfolio. We looked at some of the signature tools that we can use for identifying positions, such as the insurance tool. Other ones include the long option finder and more, so you'll have full access to that for 14 days. Afterwards, the subscription to PowerOptions start at $40 per month. That's for the end-of-day service. And then, of course, the $60 for the 20-minute delayed, which is the most popular level of service, it seems. We do also offer real-time. For the month-by-month subscription, there's no contractual obligation. You can sign up monthly after your trial for the $40, $60, or $100 per month. And if you decide to cancel it in the next month, that's perfectly fine. We'll cancel the account out for you. You don't have to be in the service for 3 months or 6 months or a year. You can just go month by month if you want to. But we do offer an annual service also as well. All right. So if you're looking for more free information, remember you all can check out the blog. Go to blog.powerop.com to see some of our articles, old and new. Of course, the webinars page on the site, those of you that have a trial, under the Home tab, you can click Free Webinars and see the recent webinars we've done, but you can also just go to powerop.com/webinars.asp. It is a public page, so you don't need to be logged in. Of course, you can always find us on YouTube as well. All right. Remember, if you do think of any questions later on, you can send me an email at any time to support@powerop.com or support@radioactivetrading.com. Either or is fine. Always call us during office hours at 302-992-7971. Remember, trial members and subscribers, you can always schedule a coaching session at any time. Lastly, from Sam, he says, doesn't think that it's possible that Ford will go to 18 from the last 5-year high it's had. But if it does have a super blowout earnings, it could go to a new all-time high as well. Okay, so that's something to consider. Rhajiv does make another quick question here. He says, when do we buy deep in the money covered call? If the stock's at 100, would we consider selling a call for 80 with 55 days remaining to expiration? Depends on the stock and depends on the premium. I mean, it really has to still have some return, but think about it this way. If every other in-the-money covered call you see on different stocks, Rhajiv, is a 0.2 or 0.3% return 55 days out, okay? So think, for example, just Apple, something with a normal volatility range, okay? So if I went into Apple, which I know is not at $100, but it's at about 200, okay? So if I go to buy the stock at about 200 and go to the 160 call 55 days out, we'll go 49. That's the best I can do. All right, so let's just do that. And I said the 160 deep in the money call. If there's a premium, it's at 31 to 33 roughly. So what is this covered call on a normal volatility stock? And Apple is a normal volatility, 0.4%, okay? Why would I do this? Well, if 0.4% matches your trading goals for 49 to 55 days, assuming that you get it every time, and the $68 profit if you get filled at midpoint, okay, which isn't too big of a stretch, and it's 31.20 to 33.55, maybe 32.10, 32.20, might only get 50 cents for 0.3, 0.25% gain. Okay, so you say, all right, well, this is normal, this is expected. This deep in the money, this is what I would expect to see. But let's use the search tool now and say, okay, would I ever we're going to go 49 days out. I don't know if there's a 55-day out right now, so we're going to go 49. We're going to go 47 days to 52 days, all expirations. I'm going to go 20% in the money, 100 to 80. That was your example, okay, on this position. I'm going to look for a max percent if assigned of greater than 0.8%, double what I just saw in Apple for the same time frame and same range in the money. Now I got to make sure there's some open interest and some liquidity on the position, that it's not fake. Anything that's going to be in the 1 or 2% return is going to have a bid-ask spread so wide that you might not get it because the implied volatility is going to be a skyrocket. So let me try to at least limit the bid-ask spread, the percent bid-ask spread on the option to under 75%. So it's, well, let's start with 65. I don't want to see something too big. Not even going to put in any stock criteria. Let's just see what's there. All right, Valiant and Tesla. Buying Tesla at 317, selling, wow. Normie, helps if it's in the money, folks, doesn't it? Let's try that again. Same numbers, but 20% in the money. Nothing. Nothing is 20% in the money for 49 days with less than a 65-cent bid-ask spread that has some open interest and a percent if assigned of 0.8. Let's go to 0.3. Nothing. Oh, all right. That's why. No one's trading them. I'll leave open interest, Rhajiv. I'm sorry. Let me take out the volume. That's what is killing the search, okay? So I'll go back and, yeah, let's put 0.8 back in. It's the volume. Those things deep in the money, no one's trading. Okay, there you go. Netflix, 360.57, July 280 at 80.85, 85.50. The deeper in the money you go, the wider the bid-ask spread is. Okay, no guarantee that you might get midpoint, but if you do, the percent if assigned is 0.9%. Why would you do this? Does this match your goals? Okay. Does this match your trading goals for 49 days out in time, 0.9 or 1.3, with probably a 92, 93% probability? See, that's what's funny. Even going this deep into Tesla, it's not, nothing's a guarantee. Sun Power, 5.5, it's still only about a 90, 92% probability, okay? Let's take a look at the Netflix chart for Mark. The percent if assigned mark, which is equal to the percent if unchanged we're seeing here, and the percent if assigned midpoint, the percent if unchanged, sorry about that, that's the return we'd make if the stock is above the strike and we're called out at expiration. So you say it means what, percent loss? Well, no, it's the percent gain. So I bought stock at 360.57. I'm agreeing to give it up at 280.57 for $80.57 less than I paid for it, but I'm getting 83.18. So $2.60 of this difference, the 80.57 to 318, that 260 value is the 0.9%. That is the extrinsic value. That is the maximum profit mark you make on a covered call if you're assigned. It's the extrinsic value on the position. Okay. So why would I do this? Well, if this matches my goals, I don't think there's a strong probability that Netflix could drop below 280. I don't have earnings coming up between now and expiration on the position, something I didn't check in the search. Let's see. Let's go back to our covered call filters we did put in. And just remember, Rhajiv, as much as you'd like to see liquid positions, when you go 20 to 30% in the money, don't look for an option volume today. I always do, but I'm not going 20% in the money. You're just not going to find anything there that's actively trading. It'll have open interest, won't have active volume. Oh, so I wanted to go to the fundamentals now in our deep in the money covered call search and click not between now and expiration. And that's it. Okay, so that Netflix position was inflated because earnings are coming up between now and expiration. Remember, the bid-ask spread was decently wide, 80.85 to 85.50. No guarantee you're going to get 83.20, 83.15. You might only get 82.80. Let's say I did try to get filled, but I only got filled at 82.80. What happens? I'll give up another 40 cents. Now I'm at 0.8. Could Netflix drop below 280 with the earnings coming up? Meh. Anything's possible. Could it gap up 80? Sure. We don't know. We just don't know in that scenario. So that's kind of the key. And Sam says Apple's one of the darlings in his portfolio because of the movement. Just remember, it does move a lot. It does move, but based on its price, it has a similar volatility. It has a low volatility of around 0.25, 0.30, 30%, you might call it, on the 50-day volatility. So it's not really high at all. It's not a high volatile stock, but it does move. A lot of the tech stocks are like that. The big name tech stocks don't have a lot of volatility. Even Netflix, 0.33. Okay, let's take a look at Apple real quick. What is Apple's? I think it's even lower than that, but 0.33, 30% volatility, 33% volatility, 23% on Apple. Do they move on a daily basis? Yes, but they're not wild swingers. Okay, they don't have volatility. In fact, let's see if I can take a look here. I'm going to go to Learning Center. It's a nice tool for, if you guys haven't seen it, this is a nice tool here. But in the Learning Center, I want to go to, oh, he didn't remove it, did he? Oh, if he removed it, I'm going to be mad. Let me go to Market Activity. Yes, I'm sorry, it's under Market Activity. There's a field here for Market Statistics. And what the Market Statistics is doing, I clicked on the wrong one. I'm sorry, let me go back. I apologize. Optionable Stock Statistics, that's what we want. The Optionable Stock Statistics. So go to Learning Center, go to Market Activity, Optionable Stock Statistics. This gives you a rundown of the average prices, the average across the entire market for bid, stock last price, and so forth, okay? So the mean, I'm sorry, that's what we're looking at. The average, the minimum, and the maximum. You know, so the average option bid price, well, why is that important? I like coming down here. So when a customer asks me, is this a volatile stock? The average stock, 50-day stock volatility right now across the market is 36.36. So that means that Netflix is below the average. Apple is 10% below the average, 13% below the average, more actually, if you break it down, it's 13 points below the average. So this is all, when someone says, what is a good implied volatility? What is a good stock volatility? I refer to the average. The average implied volatility on all options now is 0.74. Interesting, isn't it? The average implied volatility on all options right now is double the 50-day volatility on all stocks. Okay, good premiums, still available. But is it pointing to something risky? Is it pointing to the stocks may jump closer to this volatility, the average stocks, which could be a downturn, okay? One of the reasons that Sam was commenting about his trade on UVXY earlier this week, and right when he had sent the email about, was it 2 hours before you had sent that email on UVXY, I think on Monday or Tuesday, I just picked up 5 more calls on the VIX at the 16 strike for July 20th because VIX dropped below 13. So I used that for a portfolio hedge. All right. Well, ladies and gentlemen, I think that's essentially all that I have for you now. We already wrapped up with the emails and things, but let me just go back to that screen real quick. There we go. So remember, if you have any questions later on, send me an email to support@powerop.com and support@radioactivetrading.com. You can call us during market hours or schedule a session as well for all of you that are there. So Sam, Rhajiv, Jane, Mark, everyone have a fantastic weekend. I look forward to seeing you next week. You'll get some invitations to some other presentations coming up soon. And as we get into standard June expiration, what else does that mean? June 15th, 6/15. Next Friday, we're halfway through the trading year, pretty much. So it's going to be time to maybe take a look at some of your positions, what's been working, what hasn't been working, and what's going on there as well, so we can get to the rest of the remaining 6 months of the year. But hey, we're already halfway through 2018, and we're coming up to it quickly. So might have some webinars on that, on evaluating where you are and re-gauging portfolios and strategies heading into the next 6 months. Thank you again, ladies and gentlemen. Take care. We'll see you soon.